Hi, I'm Michael Batnick, and I am here with Jim Bianco, president of Bianco Research. Last week, I spoke with Cullen about what the Fed critics get wrong. Today, Jim is going to take some of the other sides of that discussion. Stick around, we'll get into it. All right, Jim. So the reason I thought that you would be such a great guest to have is because, like Cullen, you are data-driven, evidence-based, but these things are complicated. It's not black and white. So there are really solid points on both sides, and I wanted to get your take. So maybe a good place to start is this really big idea that free market capitalism is dead. The Fed is now the biggest player on the field, and risk and return are no longer connected at the hip. Rates around the world went negative. Oil went negative. Are markets broken?
Yeah, I think they are. And I think they are for what the Fed did. They stepped in, and I think it's important to understand how the Fed stepped in, because I don't want to put all of the onus on the Fed. The Fed is buying corporate bonds. They're buying commercial paper. They're going to buy ETFs. They're going to buy municipal bonds. They're going to buy personal protection payment protection plan loans. They're going to buy asset-backed securities, some other things I'm forgetting off the top of my head. A lot of that they can't do. How are they pulling it off? The Treasury is going to buy it. The Treasury is putting together 9 separate funds. Some of them are being financed through the government bailouts. Others are being financed through the Exchange Stabilization Fund. And then the Fed is allowed by their charter to buy anything that is guaranteed by the Treasury. Well, these funds are guaranteed by the Treasury because the Treasury is funding them and is in what they call a first loss position. That's highfalutin talk, first loss position for it. The Fed is the owner. The Treasury is the owner of the funds. The Treasury will be buying ETFs. The Treasury will be buying corporate bonds. The Treasury will be buying commercial paper and municipal securities. The Fed will be providing the financing for all of this as well. So that's a nationalization of markets. That is the government buying markets through using the central bank as their financier. And so anytime you see that, you have to start worrying that market signals are being distorted and that market signals aren't true anymore.
All right, so I understand all that, but what was the alternative? And I understand the buyback argument, which we'll get to in a minute, but what would the appropriate course of action for the Fed and the Treasury to take given what transpired?
All right, I'm going to contradict myself here. And I'm going to tell you that I understand what they did, and I am not violently opposed to it because the alternative would have been disaster. The 22 million people are on unemployment insurance. Here's a fun fact for you. From January of 2009 to February of 2020, we created 21.7 million jobs. In the last 4 weeks, unemployment claims have risen by 21.7 million. We have erased 11 years of job creation in 4 weeks. Steve Mnuchin, in a presser either yesterday or the day before, said he believes the Personal Protection Plan program has saved 30 million jobs. If I take him at face value, that's 52 million jobs that have either been lost or saved by PPP. If we had done nothing, that's a third of the U.S. workforce. We can't have a third of the U.S. workforce lose their jobs in 4 weeks. We'd have something worse than the Great Depression. So I'm not going to push back and say it was a disaster to do that. But what I am going to say is that this is not consequence-free. We've decided to do this. I get it. But this is not going to be, hey, we do this, it's all going to be fixed, and by the middle of 21, it'll be all forgotten in a trivia question. No, it's going to linger, and there's going to be problems associated with these programs, distortions in markets, I think, for many years to come, and it's going to be the price we're paying to try and support the economy right now.
Aside from distorted markets, and we'll come back to that, what are some of the direct consequences?
The direct consequences, I think what you've seen happen with these markets is that by artificially supporting them, you're encouraging investors to jump back into the market. Now, you can look at stocks and say, well, they did a 50% retracement of the entire decline. That's one measure. But let me use a different measure for you, the one that the Fed is really focused on. By late March, the fixed income markets, the corporate debt markets, especially the high yield market, was dysfunctional. It weren't working properly. People couldn't raise money. And by them coming in and providing support, gave investors the confidence to jump into the market and let companies raise money. So if you look at Carnival Cruise, or if you look at Six Flags, if you look at Macy's, you look at Ford, They've all raised huge sums of money at big coupon payments in the last couple of weeks, last couple of days in a few of those examples. All their pitches to investors have been the same thing. You buy this debt, and here's a big yield. In the case of Carnival Cruise, 11%. We don't have to book another cruise between now and Memorial Day of 2021, and we'll be solvent. We will still be here operating in the 2021 Memorial Day. An investor said, great, we'll have a vaccine, we'll be close to this will be over with, and everybody will refill your ships just like they were doing in the fourth quarter of 19, and I'll get paid on that big fat coupon. You will, Memorial Day 21, Six Flags will open up all of their amusement parks again, and everybody will rush into their amusement parks like they did in the summer of 2019, and it'll be just like that, and I'll get paid a big fat coupon for taking the risk. The thing that investors lost in that conversation was, will it be the same in 2021? To use an example, and this is just a theoretical example, if a Six Flags needs 10,000 people a day, paying $200, spending $200 a day after their admission a day on souvenirs and food and stuff, do they get 7,000 spending $150? That might not be enough for them to make it over to the other side. They need 10,000 to 200, not 7,000 and 150. And if there is longer term consequences, yeah, they reopen at 7,000 and 150. But if investors have priced in and demanded that they assume that there's going to be 10,000 to 200, Six Flags is not going to be able to meet those needs. So they've encouraged that kind of borrowing in the market. It may be to the detriment in the long term, but in the short term, the next year or so, it is getting us over the hump. Six Flags doesn't have to go out of business. Carnival Cruise doesn't have to go out of business. Macy's doesn't have to go out of business. And I'll put the caveat in right now. We'll have to see whether or not that's the case in 21 or 22.
Do we think that maybe we're giving the Fed too much credit and not enough credit to bond investors who are supposed to be the smart money? Like, are they not looking at the appropriate credit risks and reacting accordingly and saying, hey, I'll lend you money, but you owe me 11%?
I think that there is something to say that they are looking at it in that respect. But remember where the bond market was in the middle of or late part of March. It wasn't working properly and it was dysfunctional. These are the same people were saying, well, they're smart now. Well, were they also smart when they were saying that the bond market was so dysfunctional that it couldn't work properly? And part of that dysfunction, I'm going to remind everybody about the Fed has another function we forget. They're a regulator. And part of the function that caused the dysfunction in the bond market, and the short answer is, they put together a lot of post-crisis regulations that actually impeded on the proper functioning of the market during this pandemic because they were so worried that banks levered themselves so much in 2008. We had to put a bunch of rules to stop banks from leveraging themselves. And that became a problem in 2020 because we wanted banks to leverage themselves as well too. So yeah, I mean, it's not totally on the Fed. It's always at the margin. But at the margin, they are encouraging risk-taking again, and we'll see whether or not it becomes prudent risk-taking. We won't know for a year or two.
Okay. Where should interest rates be today, assuming that the Fed wasn't acting? Where should they be, and why are interest rates such a critical issue for how the economy functions?
Interest rates are the cost of credit, and credit is a very important metric in this, in that when you look at credit, and the price you have to pay, it becomes critically important. Now, where interest rates should be is low. There's no doubt about it that the combination of deglobalization, the combination of technology squashing the Amazon effect, squashing out any inflation that exists, and demographics. In the developed world, there are 350 million people in the developed world over the age of 65, the population of the United States alone. The proper mix for somebody who's over the age of 65's investment is probably something like a 60-40 portfolio where 40% is in bonds, and the majority of money is held by people over the age of 65. When you're 35, you're risk-taking, but you don't have money. When you're 65, you have money and you're less risk-taking. So all that money is been really pushed into the bond market to help lower interest rates. So they should be low. Should they be negative? No, they shouldn't be negative. Now, to the Fed's credit, they haven't created negative interest rates The same can't be said about the ECB and about the Bank of Japan and about the Bank of Switzerland and the Riksbank in Sweden and others. They have created negative interest rates. That's when they've gone too far on interest rates and created distortion. So I'll give the Fed a pass here. You didn't create negative interest rates. You allowed interest rates to stay low. But the other ones, the other central banks, they did go too far with this. And there's where the problem is.
So it seems like we have this fantasy about going back to the way things used to be, the way that free markets used to function. Was there ever a time where there wasn't government interference, that it was just 100% free markets? Or is that something that we're just like making up?
Yeah, 15th century in Venice, or maybe the 18th or 19th century in Hong Kong, you had complete, free markets and stuff. But no, there's always been government intervention in free markets. I think really what is new, I've studied financial history. I think what is really new here, and it started in 1979, was when the government bailed out Chrysler. In the past, before 1979, the government never bailed out companies. If a company failed, they usually dragged the CEO in front of Congress and threatened to put him in jail for fraud instead of writing them checks to bail out the companies. And then if you fast forward to 2020, everybody's getting a bailout. So I think when people say it's not like it used to be, I think what they're talking about is, capitalism without failure is like heaven without hell, that you need to have some failure. You need that creative destruction in marketplaces as well, too. As a quick example, I would tell you, I think that Tesla is a creation of the auto bailouts. That had you allowed the auto companies to go bankrupt in 2008 and allowed them to restructure and allowed them to change, they would have created a lot of what Tesla did without them. But by bailing out the companies, what you do when you bail out a company is you're saying, never change. Just stay exactly the way you are. Okay, you could you could change the paint color on the 2018 or 2019 models, but don't change. So you open up creative thinking to a company like Tesla, which eventually went too far in the financial terms. But if you look at Tesla on the other side, they pushed the electric car, they pushed the manufacturing selling idea, they've pushed a lot of other ideas away from an insane stock price that the auto companies themselves might have done had they been allowed to change, but bailouts don't allow them to change. So I don't like bailouts because what you're doing is you're telling companies to not change. You're telling companies to not be organic and grow and change and bend and fold with the new situations in life. You're trying to preserve a status quo, and that stagnates an economy in the long term.
So let's talk about an area that is being talked about as a bailout. But so the airlines, for example, there's a statistic that they spent 96% of their free cash flow on buybacks. But put them to the side for a second. What about half of the country that are small business owners that never did a buyback? Should they fail just because, hey, life's not fair and this is capitalism?
No, I don't think they should fail. And I don't think life is not fair. So if I had to twist these government programs, if I had to say on these government programs, how would I make it different? I would basically say to you that I think that they're a little top heavy on financial markets and a little bit not top heavy on the real economy. I'd like to see less of Larry Fink on CNBC thanking the government for bailing him out. And I would like to see more of real company CEOs on CNBC saying these programs are keeping my companies going, at least in the short term, over the hump. So that would be a little bit of the way that I would push this. So I get it. I think that the way that if I had to structure these programs in a vacuum or in a lab, I'd say I'm going to give you some money to get through the bail. I'm going to give you some money to get through the virus, and then when the virus is over, you're on your own at that point. Whereas it seems like what we're doing is we're creating programs to make sure that the stock market or the financial markets never go down again, and that we're promising unlimited money to promise that they will never go down again. Maybe they need to the point that we need restructuring and we need change if we're going to change our economy. By not allowing them to go down, you're arguing status quo. Nothing needs to change. And that might not be the best in the long run, that we need change and we're not allowing it to happen.
So by the Fed doing what they're doing, do you think that people are like, hey, we should take all this risk because the Fed has our back? Or do you think it's more subconsciously people are taking risks because in the back of their head, they know that the Fed put us there?
Well, by people, I think if you're going to mean corporate executives and investors, I do think that there is something to the answer that unconsciously that there is that. I've argued that the whole FOMO, TINA, there is no alternative, fear of missing out, idea has been promulgated by this idea that the Fed is going to be there every time the markets stumble to push them higher. So get aggressive, buy. Not everybody's like that, but at the margin, there's a little bit of an unconsciousness of it. At the margin, there's an unconsciousness of let's get aggressive and buy back our stock. Let's borrow a lot of debt because at the margin, the Fed is going to keep interest rates low. They're going to keep the bond market liquidity high. Keep in mind, their balance sheet purchases of treasuries that they did up until this crisis. That means the Fed, as I like to say, the Fed can buy bonds or buy treasury bonds so you don't have to. Everybody else can push their money into something like corporate bonds, giving that more liquidity. So a lot of these companies got very aggressive with their buybacks, very aggressive with their issuing of debt to fund their buybacks, because their assumption was those markets would always be there. There wouldn't be a period of high rates or closed markets that would catch me at the wrong time. And that's exactly what happened in the last month. The minute the markets closed down, the Fed came back with unlimited money to try and reopen them, to try and encourage that aggressive attitude. And it might be that aggressive attitude that got us into trouble. We don't value resiliency. The company that says, I'm going to keep 6 months of cash on reserves just in case, that CEO's thrown out. We want the guy that's aggressive. Push. And that's what gets rewarded by investors. Fine, it worked well until we got into a pandemic. And then everybody was caught with the wrong business model, which is why we've got so many problems.
Do you think that this is going to change how chief financial officers view the amount of cash that they should hold on their balance sheet?
I think it should as we go forward from here, because ultimately, I'm going to say that the Fed is holding up markets. But if you believe, as I like to joke about, if a red headline came across your computer screen and it said, Jay Powell changed his mind, canceled every program, would the stock market go down? Yeah, it'd probably be rerun 1987. So what it tells you is that we're at an artificially high level. Now, the hope is we're going to hold it up here and the economy will recover to that level so that it will then eventually become fair value and everything will be okay. But if we start to realize that, no, it's going to recover, it's not going to stay down where it is in the second quarter, but it's going to come up short, eventually the markets are going to have to sink down to whatever that fair value level is. If investors aren't ready for that risk, that could come as a big shock to them as well, too. So there is an artificial support in these markets. I understand why. I'm not going to push back against it too much because I don't want to go, completely Austrian economics and say, let everybody fail, let everybody lose their job. We'll figure it all out once everybody's unemployed. That's not necessary. But I just want to point out, I do think this is not going to be pain-free even after the virus is over, even after we find a vaccine. I don't think we go back to, what Trump says. As soon as we find a vaccine, it's bam, zoom, right back to 3.5% unemployment. I don't think it's going to be quite that simple, and that investors need to be ready for that. Sometimes I wonder if they really are.
How should investors incorporate the Fed into their decision-making process?
That's a good question. It depends on what they think that they are. I think right now they should let me take how I think you would use it down. The market is at an artificially high level from where it should be based on earnings and GDP and unemployment and everything else. We know that the economy is going to recover. Do you think the economy is going to recover so that S&P 2800 will become fair value? Or do you think it will recover to a point where maybe S&P 2300 will become fair value and the market will then start to drift back down and double bottom, because that's roughly where it was in late March or something along those lines? That's the question you need to ask yourself. If you believe, like Marko Kovanovich at Morgan Stanley, oh no, we'll be at new highs in the first quarter of next year, then you believe that we're going to go right back to the fourth quarter of 2019 in a period of weeks. And we're just going to be right back there. The unemployment rate's going to be on a straight line right back down to 3.5%. Look, that's possible. And if that's what happens, then we could go back to all-time highs. So understand the Fed is holding the market up in hopes that we recover to it. And the question you have to ask yourself is, do you think we will recover to it? I think we're going to come up a little bit short. I don't think we're going to be Great Depression. It's going to look like that in the second quarter. But I do think when we recover, there's going to be lingering effects of what we've done, and we're not going to go all the way.
I got to ask you, what the hell is going on with oil?
You know, it's amazing what's happening with oil. We're learning that there is something called negative prices. And negative prices has a big consequence. First of all, why do we have negative prices? We typically, let me use the U.S. We typically consume 10 million barrels a day in crude oil to make gasoline. In the last month, we've been consuming 6 million barrels a day of crude oil for the amount of gasoline we've been demanding. The biggest reason you and I drive is to drive to work. I mean, everybody in the country. And since we're not driving to work, we're working at home. That's why we're not consuming this. So the oil companies are producing oil, and OPEC, the Saudis and the Russians are trying to overproduce to try and drive each other out of business right now. So we produce too much, and the amount of available storage is running short. And in as little as a couple of weeks, we're going to run out of storage. So if you're an oil company and you produce more oil, you've got no one to sell it to. No one can put it into storage, into an oil terminal. So it becomes like trash. It becomes a value of less than zero. Now, let me throw in my favorite whipping boy, Robinhood, into all of this. On March 6th, Robinhood said about 3,000 of their accounts owned USO, the big oil ETF. Yesterday, it was over 100,000. They've been buying oil because their gut reaction is, oh, look, there's something that collapsed. Buy it because it always comes back. Maybe that's unconsciously thinking the Fed and the government always makes everything that goes down go back up again, especially when it comes to something as strategic as oil. If I am an oil producer and I'm pumping out this oil and they're telling me that there's no terminals for them to put it in, the Robinhood people are buying USO. USO buys futures contracts. Great. I'll sell a futures contract. I'll put my delivery on them. It's your problem to find an oil terminal. I satisfied it by selling you a futures contract. So they create this perverse incentive. I think that it was all this investor buying that needed to be liquidated that drove the May contract to minus 38. Final thought for you. There's a lot of people in today's Wall Street Journal. There was a guy that was quoted that in his Robinhood account, he bought $1,000 of USO, and he said he was willing to ride it all the way down. His assumption is all the way down is zero, because then he lost his $1,000. But if all the way down is minus $37, he loses his $1,000. And in theory, somebody's going to ask him for another $2,200 more dollars, that he's going to have to just keep writing checks for this completely worthless investment. Like a short, it's got an unlimited loss if it can go to negative as well. Now, maybe you could say in USO, we can't go back to them after their initial investment. But if the price goes negative, somebody's got to make up that shortfall. And that might be the exchanges, the clearinghouse itself, which guarantees every trade. So all of a sudden, the clearinghouses are starting to take losses. They're putting out capital calls to the banks and the investment banks to cover them. And then there's a credit risk that comes in involved with all of this stuff. So if you own S&P futures or something like that, all of a sudden there's a credit risk because the guarantor of your S&P futures, the clearinghouse, has got problems. Or maybe, who am I kidding? The Fed's just going to print money and bail everybody out at this point. But that could also be a possibility as well, too, because I've found it to be rather interesting. I think what's happening with the specter of a negative interest rate on oil, it sets up the clearing corporations and the investment banks to take unlimited losses. Because, like I said, if USO goes to zero and the price keeps going down, there's more loss being taken. Well, you can't go back to USO and ask for more money. So you, the clearinghouse, you, the investment bank, you have to eat those losses. Why aren't they demanding USO be closed today and liquidated today? Because it represents a clear and danger risk, and there's a reasonable chance we could see negative oil in the weeks and months ahead. Maybe because they think that they're not going to have to bear that cost, that somebody else is going to bear that cost, the Federal Reserve or something. So that's part of that distortion that you see in markets, because I think in normal times, there'd be emergency meetings at the exchanges with their owners, which is the investment banks and the big banks, and said, look at this risk that we have here. If that price goes to $37 again, and it's not the day before delivery, but it's like a week or two before delivery, and we wipe out all these ETFs that own oil, we're on the hook for anything below zero. So we got to get rid of this stuff. Why aren't they doing it? They're not, I think because they're not afraid that they're going to be on the hook.
You know, we live in interesting times when oil going negative is like the fourth most interesting story of the day.
I know. Exactly.
All right, Jim, last question. Powell and Mnuchin or Bernanke and Paulson? Who do you got?
I'm going to take Powell and Mnuchin. I think that they've got it better understood and they've got it better known. Bernanke and Paulson, I'm going to push off only because they had to figure it out. Powell and Mnuchin have had 12 years to kind of understand what they did. But let me point out that now that when I talked about that the Fed merged with the Treasury Department, it's Powell and Mnuchin, except Trump has a say in that equation right now as well, too. So Mnuchin serves at the pleasure of the president. The president has said repeatedly, if the Fed would print money and go to negative interest rates, the Dow Jones Industrial Average would be 10,000 points higher. He said that numerous times pre-crisis. Well, now all of a sudden, the Fed might be giving Trump the ability to print that money himself. And we'll have to see whether or not he exercises discipline and restraint. Discipline and restraint are two words you don't normally associate with Trump. So we'll have to see whether or not he actually keeps he lets them make those decisions, or if he interjects himself. He's not going to now. It's really more about when they exit. So Powell and Mnuchin, I think, got it over the other two, but you got the wild card of Trump in there.
That's a good place to leave it. Jim, thank you so much.